Good evening, everyone, and thank you for joining me today. In this presentation, we'll explore the Capstone project on finance and risk analytics. Herein, we will understand the project in hand, take a sector-wise look at the industries, examining market performance, risk profiles, and opportunities for growth. We'll also discuss and share our key findings and discuss how to apply them to attain the objective. So, as we mentioned, so let's start with the introduction of this entire Capstone project. The objective of this entire project is to explore two distinct financial objectives, each with its unique risk tolerance level. As a portfolio manager, our goal is to provide personal investment advice tailored to each investor's needs and goals. So here, meet our two investors, Mr. Patrick and Mr. Peter Jenga. Both are seeking to grow their capital, but with distinct approaches. First, we have Mr. Patrick, a conservative investor who is looking to invest $500,000 in stocks. He prioritizes low risk and has a goal of doubling his capital within the next 5 years. As a conservative investor, he is likely seeing stability and predictability in his investment portfolio. On the other hand, his son, Mr. Pidin Jainga, is a high risk investor who is looking to invest $1 million in equities. He's aiming for high returns and has a similar goal of doubling his capital within the next 5 years. As a high risk investor, he's likely willing to take more calculated risk in pursuit of greater rewards. In this presentation, we'll explore how our finance and risk analytics expertise can help us provide personalized investment advice tailored to each of their unique needs and goals. So let's proceed with the overview. What do we have? We'll be analyzing a data set of 24 stocks across various domains, including technology, aviation, financial services, and pharmaceuticals. This comprehensive dataset covers for a period of 10 years, from October 1, 2010 to September 30, 2020. However, we will be analyzing the data only for the last 5 years. We'll be looking at key metrics that provide insights into the performance of each stock, including the open price, close price, the highest price on that particular day, the low price, adjusted close price, and along with that, we'll also be examining volume traded, which gives us an idea of the market activity. And we will take a closer look at the duration to see how each stock has performed over the time. By analyzing this data, we will uncover trends, patterns, and insights that can inform our investment decisions and help us achieve the financial objectives of our two investors. Now let's take a closer look at the performance of these 24 stocks over the last 5 years. As you can see from these 9 charts, some stocks have clearly outperformed others. Amazon and Google stand out as a clear winners, with the stock prices consistently rising over the last 5 years. However, should I simply invest in them and recommend the investors to, let's say, no, hey, just simply invest in Google and Amazon? No, we need to essentially adjust for the differences in scales between the various stock performances. How do we do that? Normalization. Think think of it like comparing apples and oranges. If you just look at the prices without normalization, Amazon's massive growth might overshadow smaller but still impressive gains from the other companies, which you can see at the bottom of the chart. Normalization helps to level the playing field by making all stocks comparable in terms of their performance related to their own standards. Now let's take a closer look at the performance of the stocks when we normalize the data to account for the differences in scale. Once we have once we have done the normalization, it allows us to compare apples to apples and get a better sense of how each stock has performed relative to the others. With normalized data, some clear winners emerge. We have Apple, Amazon, Facebook, Johnson Johnson, Microsoft, Roche Holding, and United Health Group, which have shown about 80% performance over the last 5 years. A slightly smaller group of stocks, including Google, Merck, and Morgan Stanley, have demonstrated about 50 to 80 performance during this period. On the other hand, we have some industries or companies which haven't performed as well. For instance, the entire aviation industry, Barclays, Bosch Health Companies, Credit Suisse, Deutsche Bank, Goldman Sachs, IBM, Pfizer, and Wells Fargo have all shown below 50% performance over the last 5 years. Let me remind you, this is done with the help of the normalized data. So, will this analysis be enough? No. Now, we have to again deep dive into our analysis by looking at the performance of each sector. What we have done so far is analyze the individual companies, the performance of individual companies. Now, when we look at the aviation sector, you can clearly see that the sector was impacted by COVID-19 in March 2020. So there you can see a dip just after the 2020, which is basically the COVID-19. And it is showing that it has yet to fully recover. Although the market has been improving, which you can see over the red line, which is the S&P 500 index. So despite an overall improving overall market, the ongoing challenges in the aviation industries persist. So it is advisable to stay away from the aviation sector for future investment, at least for now. When we look at the finance sector, again, the pandemic has also had a significant impact on this sector, with many stocks struggling to recover. However, Morgan Stanley and Goldman Sachs stood out as a relative performers. If you can see, in they are performing really well when compared with the other companies in the finance sector. So, despite the challenges, so what insight do we gain out of this? So, despite the challenges faced by the finance sector, it's heartening to see that some companies are demonstrating their ability to adapt and thrive in difficult times. As an investor, one may want to consider this resilient players for their portfolios. Now, as you move ahead with the pharmaceuticals and healthcare industry, you can again see that this sector was also affected by the COVID-19. But some companies have shown a remarkable recovery. United Health and Johnson & Johnson have outperformed the S&P index, while Bosch Health has underperformed, which you can see in the last green line at the bottom. So what insight do we get out of this? Well, the pharmaceutical industry are likely to remain crucial in this post-pandemic world. Of course, it goes without saying, with a focus on developing treatments and vaccines for the future pandemics. So as an investor, one may want to consider companies that are driving innovation and growth in these areas. So good to know. What next? So now we have the technology sector. This sector, you can see even this sector was impacted by the COVID-19 in the March 2020. However, this sector has demonstrated a commendable recovery with Microsoft, Amazon, Apple, Facebook, and Google not only rebounding from the pandemic, but also outperforming the market index, except for IBM. I'm sorry. So, so what do we get an idea about here? So the technology sector's impressive performance is a testament to its ability to drive growth and innovation in the face of adversity. So, as an investor, I may want to consider these leading players for my portfolio. So now, after all this analysis, what is our key findings? So we calculated the annual returns. So how did I calculate that? So first I calculated the average daily returns, which I calculated for each stock by summing up the daily returns and dividing by the number of trading days. Then I calculated the risk, which is nothing but the standard deviation of the average daily returns. Then I calculated the minimum and maximum returns for each stock. After that, I converted the average daily return to an annualized return by multiplying it by 252. What is 252? It is the number of trading days in a year. After that, I calculated the annualized risk, which is nothing but the standard deviation of the annualized returns. Lastly, I measured the Sharpe ratio for each stock, which represents its excess return per unit of risk. So, what do we get from here? So the top performing stocks by annualized return were Amazon, Microsoft, Apple, Facebook, and United Health Group. These stock performing stocks have annualized returns exceeding 20% and a moderate risk profile when you compare it with other equities. Banks like Bank of America, Bank of Canada, Deutsche Bank, Credit Suisse, and Wells Fargo are had a higher risk. They are characterized by a higher risk, and as they did not generate sufficient returns to compensate for the initial investment. On the other hand, some equities offer stable returns at a relatively low risk, providing investors with a safer opportunity. For example, Johnson Johnson, Roche Holding, and Merck and Co. These stocks have a good balance of risk and return, offering more conservative options. So now we have the five good performing stocks, some very risky stocks, and then which provided a balance between high returns and high risk. Sorry, high returns and low risk. Now, since we have identified the stocks, let's proceed to create a portfolio. Now, Mr. Patrick, as we had mentioned in the initial slides, Mr. Patrick aims to double his investment over a period of 5 years. He seeks to invest in low risk stocks that generate decent returns. Based on Mr. Patrick's profile, suitable low risk stocks for investment include Johnson Johnson, Roche Holding, and Merck and Co. These are the stocks which had decent returns and low risk. To achieve, but however, we could not get the expected return that Mr. Patrick wanted just from these three stocks. So we wanted to, so we have to include a very high performing stocks with a marginal higher risk, of course. So to hence to achieve the desired returns, a portion of Mr. Patrick's wealth will be invested also in Microsoft Corporation. So his portfolio will consist of equal weightages of all these four stocks. So basically, Mr. Patrick will invest $500,000 in the above mentioned portfolio. After 5 years, the expected returns on its investment would be approximately 1.05 million, that is resulting in a gain of approximately $558,000. Now, on the contrary, Mr. Peter seeks high return investment consistent with his risk taking attitude. He believes that occasional losses can be mitigated by bouncing back and expects significant returns for inorganic expansion of his company. As you know, Mr. Peter aims to invest $1 million from the company's cash and equivalents in a single high margin stock. So based on his profile, a suitable high risk, high return stock for his investment would be Amazon. So in his portfolio, if once he has invested in Amazon, he will be investing $1 million in the Amazon stock. After 5 years, the expected returns on his investment would be approximately $6 million, resulting in a gain of over $5 million. So now we have created the profiles for both Mr. Patrick and Mr. Peter. To essentially summarize, I would like to walk you through the methodology that I used to create these two investment portfolios for our clients, Mr. Patrick and Mr. Peter. First, let me start by saying that we imported all the required libraries in Python to analyze and manipulate the data. We also loaded the CSV files containing the stock data segregated by the industry or sector. Next, I performed exploratory data analysis, also known as EDA, to get a better understanding of our data set. This involved checking for null values and dropping any rows with missing data, which was approximately 0.2% of the total data, which had literally no values or row within the entire row. Next, I also examined the dataset for outliers to ensure that our results were not skewed by any unusual data points. After EDA, we moved on to the data analysis phase. Here we calculated various metrics such as daily returns, cumulative returns, Sharpe ratio, portfolio risk, and the return on investment ROI to get a better understanding of each stock's performance. We also identified the top performing stocks based on the historical returns and discovered which stocks had returned over 80% in the last 5 years. Additionally, we performed sector-wise analysis to gain a deeper understanding of each industry or sector's performance. Sorry. Uh, then in step 4, we selected the individual stocks for our portfolios based on their unique characteristics, including risk levels and liability. So for Mr. Patrick's portfolio, we choose a mix of low risk, high return stocks such as Johnson& and Johnson, Roche Holding, Merck& and Co., Microsoft. In contrast, for Mr. Peter Jenkins' portfolio, we selected a single high risk, high return stock, which was Amazon. Finally, in step 5, we created the investment portfolios based on our analysis and the client's requirement. For Mr. Patrick, we create a portfolio that balances risk and return. While for Mr. Peter, we create a portfolio that takes on more risk in pursuit of higher returns. That's it. Our methodology to sum it up, our methodology involved data loading, exploratory data analysis, then further data analysis, stock selection, and portfolio creation. By following these steps, we were able to create two unique investment portfolios tailored to each client's needs and risk tolerance. Thank you for taking the time to review my presentation on finance and risk analytics for creating investment portfolios. I hope you found the information useful and helpful in understanding how I approached the portfolio creation. Bye.